And the question is, did you just have the weirdest recession of all time, or have we just experienced a soft landing? And I think that's going to be a pretty big debate.
If you're an investor and you log on to Twitter these days, you are going to be inundated with doom and gloom. But is it really that bad? And as investors, aren't we kind of supposed to buy when others are fearful and sell when others are greedy, to quote Warren Buffett? Those are some of the topics that we're going to touch on today with Samuel Rines of Corbu Research. He's one of my favorite portfolio managers. I'm really looking forward to this discussion. We're going to touch on energy and the U.S. economy, the Fed, and geopolitics. Enjoy. Sam Rines from Corbu Research. Good to see you, my friend. It's been a while. We got together recently at Camp Kotok in Maine. That was fun.
It's always a pleasure up there at Kotok. My word, what a time.
I know. I think I've fully recovered now, and I'm able to focus on the tasks at hand. So
I'm sorry.
It was a great time and good catching up with everyone there. One of the big topics of the day that I want to speak with you about is energy, or was energy, and it's even more so now with this week the Nord Stream pipeline being shut down, perhaps temporarily by Russia. Everybody and their brother seems to be long energy in size right now. I'm really curious because you are a contrarian's contrarian. How are you feeling about energy right now?
So I do think longer term energy is a good place to be, right? We simply haven't put enough CapEx there. But this is a temporal problem, right? You have a lot of energy on the market, kind of, and that's going to become kind of an issue, right? And you've seen it with German gas right now. You've seen it with U.S. WTI prices. You've seen it across the board. And so it's one of those where when you have call it not necessarily a glut, but when you have enough energy, you're going to have prices decline. So you've seen Dutch TTF, which is the natural gas price that we kind of use as a benchmark for Germany. You've seen that really come off in the last several days. You've seen WTI come off. You've seen Brent come off. Gasoline prices come down. That's a signal that there's enough out there. It's just a question of how do you get it to the right place at the right time. So that's kind of the mentality that I come at it from. And when it comes to Europe, it's more of a question of, is it better than feared, right? If you read the headlines right now, you would think that Europe was going to freeze for the next 6 months, and that's probably not true. And by probably not true, it's just not true. You have storage going up even after the Nord Stream pipeline was cut off. You have prices coming down after Nord Stream was cut off. That's a signal that maybe there's something else going on here that people really aren't paying attention to that needs to be addressed.
So was the European dependence on Russian gas and to a lesser extent oil, is that a false narrative? I mean, what's going on here? We're heading into winter, right? You'd think it would be peak leverage time for Russia.
Yeah, it wasn't necessarily a false narrative. It was just an narrative, right? It was a narrative that got a lot of attention because of the amount of gas that Russia sent to Germany. You have a lot of gas in the U.S., for instance, that's being pumped into LNG tankers out of Freeport, probably starting in, call it late October. There was a fire there. That's been a complication. That's going to France, Spain, the UK, et cetera, and will actually hit Germany later this winter. So you have some weird kind of counter narratives that cause problems for the Russia was the end all be all. So before Nord Stream was cut off, it was 3.2 terawatt hours a day being sent to Germany in gas. After Nord Stream was cut off, it was 3 terawatt hours. So you go from 3.2 to 3. That's not really that catastrophic, right? That's a give or take 8.5% cut. That's not something that people can't deal with. Industry usage is down mid to high teens, even into the 20s as we've gone through the summer. So you're beginning to have a significant, call it not necessarily a rationing, but you're beginning to have industry really understand what needs to be done in Europe in order to get through the winter. And that really causes a problem for the peak Russian leverage narrative.
So what about on the margin? I mean, say if, I'm just going to make numbers up here, but say if Europe, particularly Germany, has 85 to 90% of what they need for gas reserves to get through the winter.
Mm-hmm.
What happens on the margin? I mean, what about German industry? What about European aluminum producers that use massive amounts of energy? Just those two things alone could have a massive impact on the global economy. Or am I wrong?
No, they could. They will. Right? You've already seen them shut down, which is part of the reason that Germany, other parts of Northern Europe, have kind of been okay through the higher energy cost process. So they're already shutting down. They're already adapting to the higher energy market. And yeah, it'll be a problem for the global economy. It would be a much bigger problem for the global economy if the global economy was actually making anything, right? We already have layoffs at GM, at Ford, et cetera, very large aluminum users. So it's a question of, does it really affect the global economy that was already in, call it a goods collapse, or at least a goods issue on the supply chain side? And I would say that it was probably already largely priced in, right? It's not going to affect Ford. It's not going to affect GM because they're just not building cars, and they weren't anyway. It was a semiconductor problem. Now it's an aluminum problem. So it's more of a how long does it take to get to the other side story, not necessarily a delta from here story. In other words, the downturn from here.
So everything that we've been speaking about so far is really about Russian energy production. How does OPEC and the Middle East factor into all of this? Because OPEC had a token supply cut. They clearly want to maintain prices, but they're seeing prices fall. What happens in the Middle East?
This is it's an interesting question because the Qatari LNG is really important to Europe, right? So you have Qatari LNG that could really offset a significant amount of Russian energy dependence for Europe. They have one of the largest LNG tanker fleets. They have a tremendous amount of resources, and they're largely prepared to be able to deliver it. So that is one side of the equation. The other side of the equation is it was an oil cut, not a nat gas cut, right? It was we're going to pump a little less oil. I'm not sure that really matters to the global supply-demand equation. And as soon as they announced it, oil sold off. I think it was 4.5–5%. I just don't really think it matters because you're not necessarily as dependent on the Middle East for incremental barrels of oil and or OPEC and even OPEC plus. The U.S. is mainly the incremental producer of barrels, with a little bit coming out of Canada and maybe some out of Mexico. But OPEC is not really the equation maker there when it comes to oil that it once was. They didn't have the spare capacity to surge following the invasion of Ukraine, and they don't have the spare capacity now. So I think the 100,000 barrel cut was more of a shot over the bow from OPEC than a real thing.
So would you describe your position as short-term bearish, long-term bullish for energy?
Yes.
Oil specifically?
100%. Yes. Specifically, I would be, oil and nat gas look really interesting longer term. They're used in tremendous amount of products, transportation, et cetera. It's going to be very difficult to replace that. There's an interesting study out of Sweden that said basically if you mined everything that we had in the world, you could basically make one generation of electric vehicles, right? That's not exactly what you want to hear if you want to transition completely out of fossil fuels. So in general, I would say it's a pretty interesting story longer term on oil and natural gas. It's a question of when do you want to get in, because initial conditions really matter. And I would say after this crisis, so call it Q1 of 2023 or late Q4 2022 is really the time to begin thinking about building more of a, call it an oil-centric or energy-centric portfolio.
Sam, let's transition over to the U.S. economy, because this week the Fed released the latest Beige Book notes, and there were some interesting things in there. Generally, they said that economic activity had remained mostly unchanged from July, with the notable exception of the housing market, which is a lot softer. But there was one comment in their notes for overall economic activity that I want to read to you because I really want to get your take on this specific sentence. It said the outlook for future economic growth remained generally weak, with contacts noting expectations for further softening of demand over the next 6 to 12 months. So how do you interpret that? Does that mean we're in for a recession or a soft landing? What are you reading between the lines there?
So I'm reading between the lines that it's much more of a recessionary environment than a soft landing environment. But the problem there being, we've had 2 quarters of negative GDP growth, right? That's already happened, but we've had surging employment, right? It's really hard to kind of put those two together and say, ooh, recession. I think what is probably going to be odd about the coming months is that you may actually see, call it a negative Q3 report for GDP, but you might actually begin to see positive prints in Q1 and Q2 of 2023 with negative employment. And the question is, did you just have the weirdest recession of all time, or have we just experienced a soft landing? And I think that's going to be a pretty big debate. But I think the dynamics are much more recessionary, and the terminology is kind of something to be ignored, right? The terminology of, are we going to have a recession? Aren't we going to have a recession? It's much more of a, are we going to have a trajectory of negative growth or positive real growth? And if it's negative real growth followed by negative employment, those are 2 different regimes in which to invest in. And I think that's really important to understand that COVID really threw a wrench in a lot of different things. And those ripple effects are not, call it a 1 to 2 year type thing. Those are 5 to 10 year type things at a minimum. And those ripples are going to continue to go through the U.S. economy in a pretty meaningful way and make interpreting economic data and being cognizant of what's going on in a way that allows for interesting trading and interesting market ideas very, very difficult for the foreseeable future. It's very difficult to see when supply chains actually fix themselves, as we talked about aluminum in Europe earlier, neon from Ukraine, Taiwan, China. You can kind of click down through the list of, it's going to be a very long time before the world gets back to some sort of normal that we thought we knew in 2020.
Does that mean investors should prepare themselves for a higher baseline level of inflation for years?
Probably not. And this is the weird part. It's really hard to see how you're going to have significant inflationary effects, at least on the reported data. It's pretty difficult to see how you're going to have those types of really, really high prints going forward, right? You might have 2.5, you might have 2 3/4, but it's really difficult to see how used cars are going to stay as elevated as they are, right? That's really difficult to see. It's really difficult to see how the housing prices aren't going to begin to filter through to CPI, the housing prices falling, et cetera. It's really difficult to see how, we had $120 oil in February and March, 110, 100, and, right now we're at 85. So if you begin to roll those numbers through next year, you're going to begin to see some CPI prints that are much lower on a headline basis, and probably even filtering through to core as we begin to move into 2023, just on a how does it get worse kind of basis.
So I know you don't have a crystal ball, but everyone asks about the Fed. What will the Fed do? Do you feel like the Fed, given your scenario, which is quite different than other people I've spoken with recently, do you feel like maybe they'll go too far, that they'll break something?
I would say they've already begun to break stuff. I think that's already happened. They will go further and they will go farther. The question is, what else can they actually break? And I would say it's probably less to do with the U.S. economy, right? They've already kind of broken the rate-sensitive stuff in the U.S. economy, and much more to do with emerging economies that simply can't deal with a dollar that broke 110 on the DXY, right? That is an extremely strong dollar. That's going to become a problem for other parts of the world. It's not necessarily as much of a problem for the U.S., right? That's kind of the problem or benefit of having the world's reserve currency, is that you can kind of buy with an expensive dollar, and you get cheaper goods than everybody else. So I would say what the Fed breaks next is not in the U.S. What the Fed breaks next is outside of the U.S.
Okay. I know you're bumping up against the time limit, so let me just sneak one last question in, if I could. Corbu Research and what you do with Renee and I know is, it's just, the geopolitical analysis is amazing. And you always come at geopolitics from a different perspective than most. What story, if any, do you think is out there in the geopolitical sphere that impacts investors, that isn't getting enough play in the media? What are we missing?
I think what's being missed is actually, let's go with two things. I think there's two things that are really being missed. One is the corner that China is being backed into. And the second is the role that India is playing on a global scale that people really aren't picking up on very much. The corner that China is being backed into is one where it has friends in very low technology places, right? There's a great country song, Friends in Low Places. China's being backed into the corner of they're simply not going to be able to have the technology that they need to function in the 21st century as a global superpower if they don't play by the global rules. And that is a tremendous problem, and it is highly underrated there. They can kind of fight back against some of it, but it's going to be very difficult for them to play catch up in terms of the technology front if they're simply stuck without it. On the India front, India, I don't think, is getting enough attention playing middleman to the oil market. India playing middleman on the oil market between Russia, China, EU, US, etc., is a much underappreciated story. Instead of kind of sitting back and letting the other superpowers kind of play ball with the war in Ukraine, India kind of stepped in and said, wait a minute, we want to be a power broker, and we can be. They're a significant consumer of oil. They have a demographic tailwind, not a headwind, unlike basically every other country on the planet. And that, I think, is major. It's a major issue if you ignore it. That India, call it positioning between East and West, was a spectacular move by the government.
Sam Rines, great to see you. I appreciate your time. Thanks for joining me.
Thank you.
You can follow Sam Rines on Twitter at Samuel Rines. Sam is from Corbu Research along with Rene Anino, and I said his name wrong. So Rene, if you're watching, apologies for getting your last name wrong. I do appreciate everything that you guys do over at Corbu. If you enjoyed this video, please take a minute to subscribe to the Malden Economics YouTube channel. We really appreciate your support. Thanks for watching. I'm Ed D'Agostino. See you next week.